As the NASDAQ has already broke the closing all-time high, what is in store if SPY does the same? Let's go. So going ahead and looking at the monthly here, and I went ahead and set this into log scale, and that's because, when you have prices that go back all the way from $70 back in the 2008 time period, and then fast forward to today, we're flirting with close to 500. If you don't put it on log scale, you won't get the proper line layout. So I went ahead and flipped that. And we're just going to grossly kind of go through this today. I'm not going to, explain all the Elliott wave rules and go through every last little piece of them, but just enough so that we can be dangerous and understand, the main concept of what I'm going after here. And it should be enough to help us figure out both the bullish scenario and, the bearish scenario. So let's start with the bearish scenario first. And first of all, we just got to get ourselves grounded that, typically Elliott wave rules, there's like a idea here where you put in, a first wave, then you put in a second wave, and then you go ahead and the question is, where did you put in a third wave? Was this the conclusion of the third wave? And then we put in a fourth wave, and it's always based on closing price. But again, we're not going to, go down to any kind of time frame to get too cute with it. And then, you would have put in a fifth wave here. So, that would have been the bearish scenario as we kind of lightning bolt higher, into this all-time high. And then once you reach this all-time high, what would have happened is normally after you have this type of wave, you're going to have a corrective wave. And of course, there's many different types of corrective waves, but one such corrective wave would be a zigzag. And a zigzag is where you come down and then you retrace upward. And typically on this retrace upward, you could kind of stop at a 50% retrace and then more likely in the golden pocket. And today, if you want to know more about retrace and some of all that kind of stuff, when I start talking about Fibonacci retraces, you can go ahead. I have a short coming out on that tonight. You can watch that and it will give you some idea on what the golden pocket is, where it's a 65%, 50%, so on and so forth. It'll give you just a little bit of context of what all the shorts are. So that's getting released tonight as well. So now this area really gets critical here because what happens is from an Elliott wave rule standpoint, it essentially says, when you're in this zigzag and you come back up, that if you start to actually break above our prior all-time high, then you are violating, that rule on a closing basis that, this is not a zigzag, then it's something else. But then the question becomes, what could be that something else? Because if it's the bearish scenario, if we remove, that extension there, if we were to come back down, and let's say even if, we kind of put in a minor wave here and we didn't cross this all-time high, you would then be entering, your third wave, which the third wave is going to have, either the same size, it could be like a running flat, or, it could start to have an extension on this where you go to like the 1.6 or the 2.6, or some kind of like, multiple of that. And then when you're at this spot, you could say, well, either we did corrective. Now, sometimes these corrective waves, you could have a 5 wave, followed by another 5 wave, or this could have just been the end of that corrective wave and then you move higher. But like I said, if we went ahead and we broke through here, essentially then what you're doing is you're nullifying that this area here is now going to enter a downtrend. That would not happen. So that's why, this 1% that we're coming into becomes so super critical. Because if we break and close above this, then something else is going on. Now, we'd have to rethink, was the 5 wave that we drew here correct? And so then we'd have to reevaluate that. That's what Elliott would tell you to do, because Elliott waves become a lot simpler to see after the fact. So if we started to redraw this, maybe this was the first wave, maybe this was the second wave, and maybe what happened here was this was the conclusion of the third wave, and then we had a pullback here for wave 4, and then that means, then we'd be in a wave 5 right now. And if we were in a wave 5 right now, what that really means is, again, it would have like, a wave 1, a wave 2, And then wave 3 would be like the largest wave. It could be either equal to the first wave, subwave there, pull back and then go into a final blow off top scenario. So this could be, what we're talking about being a fifth wave right here. And this is why, even if you watch the video from last night, if you see in a declining interest rate environment, equities normally want to go up, not down. And so, usually when the stock market is positive, it has a tendency of, wanting to be more positive, not saying, oh, well, some guy on YouTube told me it's time to pull back. Because it doesn't necessarily have to do that. Once it starts to break to new highs, that's generally the way it wants to go. If this is something you're finding useful, then go ahead and subscribe, as I do this type of different technical analysis all the time, and hopefully it's easy to understand. And why don't you go ahead and let me know that in the comments below as well, giving us kind of a heads up that it was going to be a nothing burger. As that's all I have for now until the next video, and we'll see you then.